You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, how's it going? It's Jonathan Rose and welcome to Masters in Trading Live. Masters in Trading Live, we go over the market every day. The market's open 11 o'clock Eastern time. You'll notice, that didn't work. You'll notice, and now it's gone, there was a little cool thing that you could take a picture of and that'll connect you with our customer service, get all your questions answered about All Access. We are having a heck of a week, and it's only Tuesday. How exciting. 4 topics to cover today, guys. We have the first thing we're going to talk about, NASDAQ line in the sand. We talked about a NASDAQ line in the sand last week. I want to talk about that same level this week. A great question about stocks that are hard to borrow. I want to cover that. We're going to talk about vertical spreads, and then also we're going to have a little pop quiz at the end. Before I get to the slides, I want to talk about a topic that I had a question about, which is really important. It's called rolling your options position. I hate the word roll. Should we roll our options position? I hate. Here's why. What it means, if you're long an option, let's say you're long the 13 strike calls and a stock's trading 10, and you're long the 13 strike calls in July, and July is going to expire this week, and you're like, I love these 13 strike calls. I'm going to roll them so I have more time because the stock's at 10. Now, why I don't like that? Because what you're doing is you're committing to adding another trade. So what you're doing in this circumstance, when you say, I'm going to roll, I'm going to give myself more time, you're getting out of your options that are going to expire in July, and you're buying more time. So you're doing a whole nother trade. What I want you to do, rather than rolling, which just automatically assumes you're going to stay in the trade, start from the beginning. You need to consider that second trade the same way you would consider any other trade in the market. There's a bias to you because you lost money. So therefore you want to roll because you don't want to lose money. Nobody likes losing money. I want you to think that never roll. I want you to decide whether you want to be in that trade. And if there's a coincidence that you end up happening in the same trade with more time, that's a good trade. But what you don't want to do is say, I like rolling my position. If my trades don't work out, I'm just automatically going to roll. What you end up doing there is just getting yourself stuck in a whole bunch of crappy positions. Let's go to the slides. Man, it seems like we've been doing this every single day. I got this great feedback this morning. Joined in May. Options are a whole new world to me. Invested in equities all my life. Even with small trades, I've now covered the 2K fee to join the Advanced Notice program. So congrats. Why I wanted to share this, well, besides me just being very excited, it's also that you don't need options experience. This is interesting. The mental hurdle of willing to lose 100% of your investment. When we buy options, we are risking 100% of our investment, but we make that decision before we get into the trade. When you're buying options, if you have 10 different trades and 3 of them you end up making 300% on, maybe 4 of them you end up breaking even, some you take a little bit of a loser, and some you lose 100%, that's okay. When you're buying options, you get massive leverage, and we're looking for big returns. So congrats, you're getting smarter. You're giving yourself more options, more ways to manage a position. Okay, so QQQ, last week we had our line in the sand. We had our line in the sand at 505. The reason this trade worked so well is because we had a catalyst. The catalyst was CPI. CPI came out last Thursday. So when we traded right up to 505, that's why I was willing to share trades. When the market comes off, we get out of those trades. But what I don't want is right now, we don't want to keep that line in the sand. When I took this, all the volatility indices were lower. Let me just check real time. VIX 9-day is 1209. The market cannot really fall with the VIXs this low. So if anything, the market's going to be strong, but we don't want to just defer to this one line. This was the line from last week. We need to reevaluate the trade if the market gets up there, and let's look and see what the volatility indexes are doing. Don't just, because you did a trade once, think that you're going to be able to do the trade over and over and over. Let's talk about hard to borrow stocks. Short inventory. This is what the brokerage holds. If they have a lot of short inventory, it's going to be very, very easy to borrow. Okay? If they don't have a lot of inventory, it's going to be very difficult to borrow and sell that stock. So let's go hard to borrow. Hard to borrow stocks indicates difficulty in borrowing shares to short. Okay? You're going to be able to see the effect on hard to borrow stocks in your puts, because increased premiums due to higher demand from traders using puts as a short alternative. So think about it. If I sell puts, that's bullish, right? Well, if I wanted to get delta neutral, I have to sell stock. That's why those puts are going to be more expensive. Okay? People want to buy puts when it's hard to borrow because it gets them short stock. This is when hard to borrow stocks are more expensive. What about on the calls? Same thing. All options are going to be more expensive when stocks go hard to borrow. Why? Well, they're going to be more expensive because if you buy calls, that's going to get you long. You need to sell stock. It's more expensive. Okay? So therefore, if you sell calls, that's going to get you short stock. That's going to get you that hard to borrow stock, right? That's why it's more expensive. So the puts and the calls, everything will be more expensive when stock gets hard to borrow. Okay? More volatility, more uncertainty. And therefore leads to an options imbalance affecting premiums in both puts and both calls. Pop quiz time. Yep, I didn't announce this, guys, but that's what pop quizzes are all about. So what I'm going to do right now in our advanced notice Discord channel, you guys are going to get to answer the questions from the pop quiz. If you're not in the Discord and you're out there watching, please participate. Do your best. Hopefully you get the right answers. Let's see how we do. Okay, here we go. Stocks trading at 13 in this phony baloney example. 10 days until expiry. What's the price of the straddle? What's the price of the straddle? If I wanted to buy the straddle right now with 10 days to go until expiration, what's the price? What's the price? I want to buy the straddle. I want to buy the calls. I want to buy the puts. What do you think? What's the price of the straddle? I'm really hoping I'm on a 5-second delay because no answers are really jumping up. So that's the first question. What's the price of the straddle? The next question, what's the price of these 11s right here? What's the price of these calls, these 11 strike calls? Jeff, thank you. Jeff comes in with the answer. Bravo, bravo. Okay. So the straddle, correct, is going to cost $2. Next question. What's the price of these 11 strike calls? What do you think? What's the price of these 11 strike calls? Okay, we got some answers coming in. Let's see. Well, the price of these are going to be $1 of intrinsic, 80 cents of extrinsic. The value of these are going to be $2 of intrinsic, 13 minus 11, 50 cents of extrinsic. Okay, see how that works, guys? If you'll notice, the premium in your puts and the premium on the calls are exactly the same. Isn't that cool? So 12s, it's going to be $1 of intrinsic and then 80 cents of extrinsic. Another question. What's the price of the 14-16 vertical call spread? Vertical call spread. What's the price of the 14-16 vertical call spread? What do you got? 14-16 vertical call spread. So the 14-16, we want to buy and we want to sell. 60 cents. So you can buy the 14-16 call spread, buying for a debit, 10-cent credit, 60 cents. That's $600 of risk on a 10 lot. The most that you can make is the difference between those two strikes, right? Awesome. You guys got it. So there, 14-16 call spread, 60 cents. Here's your last question of the pop quiz. This one's tough. 14-16 vertical spread, vertical call spread is trading 60 cents. What's the put spread trading at? What's the 14-16 vertical put spread trading at? Uh-oh. That's going to make this tough. What do you think? If the 14-16 call spread is trading for 60 cents, what's the 14-16 put spread trading at? $1.40, right? Because this trades for 60 cents. And they have to balance one another out. So if your 14-16 call spread is 60 cents, 14-16 put spread is going to be that $1.40. This is where you can see how calls interact with puts and how puts interact with calls. It's really cool once you see it just kind of put out like this and simplified as much as possible. Hope you enjoyed that. If you didn't get a chance to do the quiz, go over that section, take it slow. Learning vertical call spreads. It's a great way just to get into your position because your risk is fixed. You know exactly what your risk is. You know exactly what your reward is. But also using vertical spreads to manage your trades is also really, really valuable. In our all access portion of this presentation, we are going to go over a couple of names that are expiring at the end of the week and talk about exactly how to manage them. Thanks for watching. We'll be on here live again tomorrow, 11 o'clock Eastern Time.